The Gateway to Latin American Connectivity, a comprehensive guide to TIGO, Millicom. As of January 22, 2026, investing in Millicom International Cellular, ticker TIGO, known throughout Latin America by its brand name TIGO, means investing in the digital backbone of one of the world's most rapidly evolving emerging markets. For an investor today, Millicom is no longer just a telecom stock. It is an infrastructure and fintech play. The company has spent the last 2 years aggressively shedding non-core assets to focus entirely on 9 key Latin American markets. This guide explores the company's convergence strategy, its massive 2026 expansion into Ecuador and Uruguay, and the unique risks of operating in a region defined by high growth and currency volatility. 1. The business model: building digital highways. Millicom's core philosophy is centered on building digital highways. In markets like Guatemala, Paraguay, and Panama, TIGO is often the primary provider of both the internet people use at home and the signal they use on their phones. The 3 pillars of TIGO. Mobile services. Serving approximately 42 million customers, TIGO provides prepaid and postpaid wireless services. In 2026, the company is successfully migrating millions of users from prepaid, pay-as-you-go, to postpaid, monthly contracts, which creates a much more predictable and resilient cash flow. Home, broadband and TV. TIGO's fixed-line network reaches 14 million homes. The home segment is the company's highest margin business, as high-speed fiber-optic internet becomes a necessity for remote work and education in Latin America. B2B and fintech. Under the TIGO business brand, the company provides cloud and security solutions to small and medium enterprises. Additionally, TIGO Money is a burgeoning digital wallet that facilitates millions of transactions for the unbanked population, positioning Millicom as a competitor in the fintech space. 2. The 2026 strategic pivot: consolidation and scale. The biggest headline for TIGO investors in early 2026 is the completion of its acquisition of Telefónica's operations in Ecuador and Uruguay. Why the Ecuador deal matters. On January 15, 2026, Millicom finalized the $380 million purchase of Telefónica Ecuador. Dollarized stability. Ecuador is a dollarized economy, which is a holy grail for an emerging market telecom. It allows Millicom to earn revenue in US dollars, eliminating the currency translation risk that often plagues its operations in countries like Colombia or Paraguay. Market leadership. TIGO is now the number 2 player in Ecuador, providing immediate scale and a massive cross-selling opportunity for its broadband and digital services. The neo-cloud momentum. By expanding into Ecuador and Uruguay, Millicom has solidified its position as one of the few pan-regional players capable of competing with giants like América Móvil, Claro. 3. Financial health, cash flow, and dividends. Millicom enters 2026 with a vastly improved balance sheet compared to the heavy debt years of 2021-2023. Key performance metrics: January 2026. Operating efficiency. The company's adjusted EBITDA margin reached a record 46.7% in late 2025. This reflects a cost-cutting DNA that has removed hundreds of millions of annual waste. Free cash flow. Millicom is currently a cash machine, generating roughly $800 million in equity-free cash flow annually. This cash is being used for 3 things: debt reduction, M&A, and shareholder returns. The 5% dividend yield. For income-focused investors, TIGO is a standout. As of January 2026, the company pays an annual dividend of $3 per share, distributed quarterly, resulting in a yield of approximately 5.15%. Valuation gap. Despite a 130% share price return over the last year, many analysts, including those at UBS and JP Morgan, argue the stock is still undervalued. With a PE ratio of roughly 8.7x, TIGO trades at a significant discount to its US peers like AT&T or Verizon, despite having much higher growth potential. 4. Technical evolution, the 5G and fiber race. In 2026, the digital highway is being upgraded from asphalt to high-speed rail. Infrastructure milestones, 5G deployment. Millicom has now deployed 5G networks in 12 major urban centers across its footprint. While 4G remains the workhorse for the majority of the population, 5G is the key to capture high-value corporate clients and the gaming demographic. Fiber expansion. The company is currently spending $650 million to $700 million annually on capital expenditures, CapEx. Most of this is going into fiber to the home, FIT, which offers significantly higher speeds and lower churn, customer cancellation rates than old copper wires. Tower divestment. In a move to become asset-light, Millicom has been selling its physical cell towers to third-party tower companies and leasing them back. This unlocked billions in cash that was used to pay down debt and fund the Ecuador acquisition. 5. Critical risks, the anti-TIGO case. No emerging market investment is without significant risk. For Millicom in 2026, these are the primary concerns. 1. Leverage and debt. While debt has been reduced, the company still carries a debt-to-equity ratio of 2.53. The recent acquisitions in Ecuador and Uruguay were strategic, but they prevented the company from reaching its goal of keeping leverage below 2x. If global interest rates remain higher for longer, the cost of refining this debt could eat into profits. 2. Political and currency volatility. Outside of Ecuador and Panama, TIGO earns its money in local currencies, like the Colombian peso or Paraguayan guarani, but pays its debt in US dollars. A sudden devaluation in a key market can wipe out a year's worth of growth on paper when the results are converted back to USD. 3. Competitive pressure. The telecom market in Latin America is a blood sport. Competitors like Claro, owned by Carlos Slim, and new digital entrants like Millicom in certain regions are constantly in price wars. If TIGO is forced to lower prices to keep customers, its profit margins will suffer. 4. Low capital intensity risk. Some analysts have expressed concern over Millicom's capex to sales ratio of 12.2%, which is lower than many of its global peers. The risk is that if TIGO doesn't spend enough today on network upgrades, it might lose its technology lead to a more aggressive competitor by 2028. 5. Investor strategy. How to approach TIGO. The emerging market anchor. Think of TIGO as a way to play the digital inclusion of Latin America. As more people move from offline to online, TIGO is the toll booth they must pass through. The dividend compounder. With a 5% plus yield that is well covered by free cash flow, TIGO is an attractive pick for total return portfolios, combining steady income with the potential for stock price appreciation. Watch the dollarized mix. As an investor, the most important metric to watch in 2026 is the percentage of revenue coming from dollarized markets, Panama, El Salvador, and now Ecuador. The higher this percentage, the safer the stock becomes from currency crashes. Conclusion. The scarcity value of connectivity. Millicom, TIGO, in 2026, is a company that has completed its ugly transformation phase and is now reaping the rewards of its focus. It owns the premier digital infrastructure in countries where the population is young, tech-savvy, and increasingly hungry for data. While the political risks of Latin America will always provide bumps in the road, the company's 46% EBITDA margins and its strategic expansion into stable, dollarized economies suggest that the TIGO story is just getting started. The verdict. If you can handle the volatility of emerging markets, TIGO offers a rare combination of value, low PE ratio, income, 5% yield, and growth, Ecuador expansion. It is a bet that the future of Latin America is digital and that TIGO will be the one providing the connection.